Hi, this is Vijay Bambani, and I'm back again to talk about something that really interested my viewers and for which I've received a good amount of feedback on my social media pages. How to trade derivatives better. In my previous two videos about trading, I discussed about futures, and I wish to continue about futures again as well in this video. Please keep your feedback coming and let me know how much deeper you want to go so I can take it to the next, and the highest level. So, last time in the video, we talked about how turnover is very important because you want to get into liquid contracts and not pay too much of a spread between the bid and the offer or the buy and the sell. We talked about liquid contracts. We talked about the market-wide position limits, which ideally should not be too high and definitely not bordering on 90% because you're risking going into a stock which can go into a ban period. This time around, I wish to talk about what I would do for a change rather than what you should do. I'll talk about what I would do in an ordinary trading session, a routine trading session. The number one thing is I would Google search the background or any news flow about that particular company whose stock I'm going to trade today. The idea is to take into account any kind of news flow or fresh events or developments that could have occurred after I went to bed last night, but before the market opens in today's trading session. The other thing that I would keep in mind is what happens in the first 5 to 7 minutes. You see, there are various kinds of traders in this markets and they take position in the markets depending on their mindset, their aptitudes and their attitudes. What we are in our personal life, that kind of trading and that kind of mindset, aptitude and attitude filters down to our professional life as well. So high risk takers will take extremely risky bets, whereas low risk takers or risk averse traders will go in for low momentum or low beta items, low volatility items. Now, what really happens in the first and last 5 minutes of trade? There are various types of traders, as I told you. Some are intraday traders. They would enter into a trade when the market opens and square up their position before the market closes. Whether a profit or a loss does not matter. This is called going flat out. Remember the ECG which you see, which is flat of a dead person? Their order book or their trade book goes flat, which is dead. If there's a loss, they go back to the drawing board and attempt to recoup that loss on the next trading session. If there's a profit, that's fine. They want to add on to that profit to the next trading session. But overnighters or carry forward of that position is not allowed. Now, there are other kinds of traders, like swing traders who enter into a position, wait for a couple of trading sessions till the stop loss or the target price is hit. The third kind of traders are BTST and STBT traders. BTST stands for buy today and sell tomorrow. STBT traders are short today and buy tomorrow. These traders would typically enter into a trade on day one, 2 to 3 minutes before the market is about to close, so that they are as close to the closing price as far as possible. And on the very next day, they would square up their position within the first few minutes so that they receive a price which is as close to the opening price as far as possible. By now, you would have guessed that the last 3 minutes of a trading session and the first 3 minutes of a trading session are dominated by the BTST and the STBT traders, and therefore there is extreme amount of volatility in prices. Think of it as churning. Very frothy waters, there's a lot of foam and the liquid is actually way down and there's a lot of foam on top and it's like a smoke screen. So the first thing I would do is avoid entering into a trade in the first 3 minutes or the last 3 minutes of the trading session. This is sometimes the best time for big ticket, strong-handed players to fool the people by creating gap ups or gap downs in prices. This is where a rank and file retail trader gets sucked into making mistakes. So if you were to avoid the first and the last 3 minutes of trade, do your math. Maintain a trading journal as to what time you entered a trade and why, and what time you exited and why, and what was the net result, a profit or a loss. I'm sure you will realize that many a times you could have simply avoided a loss by timing your entry and exit. The second thing I would do is try to avoid any trade on the long side where the current market price is below the average traded price for the day. Where can you find this? On your trading terminal itself. Whether it's your mobile phone, it's your desktop application, or a browser-based application of a trading terminal, you can always see the average traded price for the day, which is an average of all the trades taken place from the market opened till this very second. So if you want to go long, make sure that the current price is above the average traded price. On the flip side, if you want to go short, the current market price must be below the average traded price, which tells you that you have a higher probability of success because you're going with the flow in the market. I'm sure you receive a lot of gyan in the morning on WhatsApp. I normally tend to avoid it, but once in a while a few pearls of wisdom do filter in. One which keeps cropping up in my WhatsApp inbox every couple of months is, do not tell me what you feel about me. I will gauge your thoughts about me through your actions, which is actually distilled wisdom of life. People can say whatever they want about a stock. It's what they do in the market that impacts the price. So apart from all the fluff that is created in the public domain across various platforms, what happens to the price, which is the current market price versus the average traded price, tells me whether money is going into that counter or flowing out of it. I would never want to break this golden rule of trading futures, ever. Because that would leave my flanks open to a vulnerability of a loss. So go with the flow, see where the people are actually putting in or taking money out of, and stay with the majority. You might want to play contrarian, which is what I have mentioned in a video a couple of months ago about me calling Indonesia's bluff in nickel. Now that is a contrarian call which spanned over many days and weeks. That was not about day trading. When I'm telling you now about futures, the current market price being above the ATP for longs and below the ATP for shorts, that is day trading. You do not want to violate this rule. And then again, please do note about the traded volumes. Do not get into anything which is traded less than 3,000 marketable lots in the last 5 trading sessions on an average per day. So 3,000 lots per day. The higher, the better, so that the spread is thinner. More about trading futures in my next video. So do keep watching this YouTube channel. Do not forget to click on the like button. Subscribe to my YouTube channel. In the comment section, do let me know what you thought about this video and what else you'd want me to cover in my future videos. And feel free to share this video with your family and friends. This is Vijay Bambwani signing off for now. Do take very good care of your trades and investments. Thank you. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.